something strange just happened, and almost nobody is talking about it. While most crypto traders were watching red charts, panicking, selling, and waiting for Bitcoin to recover, something completely different was happening behind the scenes. XRP quietly pulled in over $50 million. Not hype money, not retail traders chasing pumps. This was institutional money, smart money. And here's the crazy part. It didn't happen during a bull run. It happened during fear. At the same time, Bitcoin ETFs were bleeding money. Ethereum was seeing outflows. Other major assets were struggling. But XRP, it was moving in the opposite direction. So the real question is, why? Why would institutions choose XRP right now? When the market looks uncertain, what do they see that retail traders don't? Because once you understand this, everything changes. And it doesn't stop there. Just weeks before this happened, Japan quietly set a deadline, not for regulation discussion, not for some vague future plan, a real deadline, Q2 of 2026. That's when XRP is expected to shift into something completely different, not just a crypto asset anymore, but a fully regulated financial product in one of the largest economies in the world. Let that sink in for a second. This isn't about price anymore. This is about category change. And if you've been in markets long enough, you already know when an asset changes category, everything follows. New money, new rules, new players. But here's where it gets even more interesting. At the exact same time, the Federal Reserve made a move that most people completely ignored. Everyone was focused on interest rates, whether they go up or down, whether Powell sounds hawkish or dovish. But the real signal was hidden in something much more technical. The Fed announced it would start buying Treasury bills again. Now, you might be thinking, what does that even mean? Let's simplify it. When the Fed buys Treasury bills, it injects liquidity into the system. It's like adding fuel into an engine. More fuel, shot more movement. Banks suddenly have more reserves. And when banks have more reserves, they start doing what they always do. They expand, they lend more, they move capital faster. They look for efficient ways to transfer money across the world. And this is where things start connecting. Because when institutions begin moving large amounts of capital globally, they face a problem. The traditional system, the SWIFT network, is slow. It requires pre-funded accounts in different countries. Money gets stuck, transfers take time, and billions of dollars sit idle just to keep the system running. Now imagine a solution that removes that friction, a system where money moves in seconds. No pre-funded accounts, no delays, no inefficiency. That's exactly where XRP enters the picture. XRP's on-demand liquidity system allows institutions to move money instantly across borders without locking up capital. And suddenly, it makes sense. Liquidity is increasing, banks are getting the green light to engage with digital assets, and institutions need faster, more efficient systems. This is not hype, this is structure. This is the kind of environment where real adoption begins. And here's something even more important that most people missed. The Federal Reserve didn't just add liquidity. They also made it clear that banks can work with digital assets. That's a huge shift because for years, banks were hesitant. Regulation was unclear. Risk perception was high, and many institutions stayed on the sidelines. But now, the message is different. The signal is clear. Liquidity is coming back into the system, and banks are allowed to participate in digital assets. So think about this for a moment. If you are a large financial institution, you now have more liquidity, regulatory clarity improving, and access to digital asset infrastructure. What's the next step? You look for the most efficient tool, and that's where XRP starts to stand out, not because of hype, but because of function, because it solves a real problem that institutions actually have, moving money fast, cheap, efficiently. And here's where timing becomes everything. The Fed's liquidity injections don't show results overnight. They take time to flow through the system, months, which means by the time we reach mid-2026, that liquidity will already be circulating. Institutions will already be positioning, and they will already be looking for solutions. Now combine that with Japan's timeline. By Q2 2026, XRP could be treated like a stock or bond in a major economy. That changes everything, because institutional investors don't operate in gray areas. They need rules, they need compliance, they need clarity. And once that clarity exists, capital flows, big capital, pension funds, insurance companies, sovereign wealth funds, the kind of money that doesn't chase hype, it waits for structure, and then it moves. So now you're starting to see the bigger picture. This isn't just about XRP price. This isn't just about crypto trends. This is about three powerful forces aligning at the same time: liquidity, regulation, and infrastructure. And we've only just started connecting the dots, because what's coming next is even more important. Who is actually ready to handle all this institutional demand? Because having liquidity and regulation is one thing, but having the infrastructure to support it, that's a completely different game. And this is where the story takes a turn that most people are completely underestimating. Before we go deeper, I want to ask you something. Do you think institutions are already positioning quietly, or are they waiting for the official news? Drop your answer in your mind right now. We talked about liquidity from the Federal Reserve and the regulatory shift coming from Japan. But there's one critical question we left hanging. Who is actually ready to handle institutional demand? Because here's the truth. Most people don't understand. Institutions don't just jump into a market because it looks promising. They need infrastructure. They need systems that feel familiar. They need platforms that work like traditional finance, but with the speed of crypto. And this is exactly where Ripple made a move that almost nobody is talking about properly. In 2025, Ripple didn't just sit and wait for adoption. They built aggressively, strategically, and very quietly. They spent over $2.4 billion building something most people still don't fully understand. Not hype, not marketing, but real infrastructure. Let's break this down step by step, because this is where the puzzle starts to click. First, the treasury layer. Ripple acquired a company called G Treasury for around $1 billion. Now, at first glance, that might not sound exciting, but what does a treasury platform actually do? It manages money, corporate money, huge money. We're talking about Fortune 500 companies, the biggest businesses in the world. These companies don't just hold cash, they actively manage it. They decide where to store it, how to move it, how to optimize it, and collectively, these corporate treasurers control trillions of dollars globally. Now imagine this. If Ripple integrates XRP directly into this system, it doesn't need to convince companies to try crypto. The system is already there. The workflow is already trusted. All Ripple has to do is offer a better way to move money inside a system companies already use. That's not adoption through hype. That's adoption through integration. And this is how institutions actually move. Now let's go one level deeper. The second major move, Ripple acquired a prime brokerage platform called Hidden Road for around $1.25 billion. And this one is even more important because if you don't understand prime brokerage, you don't understand institutions. Prime brokers are the backbone of institutional trading. They provide liquidity, access, custody financing, trade execution, basically everything a hedge fund or large investor needs. Without a prime broker, institutions can't operate efficiently. So when Ripple turned this into Ripple Prime, they didn't just enter the market. They created a bridge between traditional finance and crypto. Think about that. Now an institution can access XRP liquidity store assets, securely trade with confidence, and operate under familiar structures all in one place. This removes friction, and when friction disappears, adoption accelerates. Because institutions don't want to learn new systems. They want crypto to fit into their existing systems. And Ripple understood that perfectly. Now let's talk about the third piece, the payments layer. Ripple acquired a company called Rail for around $200 million, and this one connects directly to the future of global payments. Rail focuses on cross-border transactions, stablecoin settlements, fast payment infrastructure. Now here's why this matters. Stablecoins are exploding. They are already being used for remittances, business payments, international transfers, and they are growing fast. So Ripple didn't ignore this trend. They integrated it. Now they have XRP for liquidity, stablecoins for settlement, and infrastructure to connect everything. This is not just one product. This is an ecosystem. Now step back for a second and look at the bigger picture. Ripple now owns a treasury system used by major corporations, a prime brokerage for institutional investors, a payment network for global transactions. That's not random. That's a complete financial stack. And here's the key insight most people miss. They built all of this before the regulatory clarity fully arrived. That means one thing. They are not reacting to the future. They are preparing for it. Now connect this back to what we discussed earlier. By mid-2026, three things are expected to align. The Federal Reserve increases liquidity, Japan provides regulatory clarity, Ripple's infrastructure is fully operational. This is not coincidence. This is convergence. And when convergence happens in financial markets, things move fast, very fast. But here's where it gets even more interesting. Because all of this sounds good in theory, but is there actual proof institutions are already moving? Or is this just a future narrative? Let's look at the data, because numbers don't lie. In early February 2026, something unusual happened. While most major crypto ETFs were seeing outflows, XRP ETFs saw inflows. Over $51 million flowed into XRP-related ETF products in just days. And this wasn't random. The money went into institutional-grade products, not meme tokens, not speculative plays, real financial instruments. This is important because ETFs are not retail playgrounds. They are institutional gateways. And when money flows into ETFs during fear, it usually means one thing. Smart money is positioning early. Now think about how institutions operate. They don't wait for headlines. They don't chase hype. They position before the narrative becomes obvious. They accumulate when prices are uncertain. They build positions quietly. And by the time retail notices, it's already too late to get in early. And here's something even more powerful. Real adoption doesn't show up on social media. It shows up in usage. And XRP usage is increasing. More financial institutions are using on-demand liquidity. More corridors are being covered. More transactions are happening in the background. This is not speculation. This is utility. And utility is what drives long-term value. So now ask yourself this. If institutions are building infrastructure, getting regulatory clarity, gaining liquidity access, and already positioning, then what phase are we actually in right now? Are we early or are we already late? Because the market doesn't wait. It moves when structure is ready. And this brings us to the most important part of the story, the timeline. Because everything we talked about is leading to one specific window, a window where all these forces collide. And when they do, the impact could be much bigger than most people expect. In part 3, we're going to map out the exact timeline and show you when this convergence is expected to happen and why summer 2026 could be the turning point.